Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, we'll start off with a pilot episode of the new Morningstar equity-focused podcast, Market X-Ray. Then, Jonathan Guyton joins the ongoing discussion about withdrawal rates, and Ben Johnson gives his take on a potential new cryptocurrency product. So let's get started. Here are Ivana Hampton from Morningstar Inc. and our equity analysts from Morningstar Research Services.
A wave of reopenings are unleashing opportunities for many people ready to venture outside, and they're looking to go on vacation. Airlines, cruise lines, and vacation rental companies are hoping to benefit. But what opportunities exist for investors also hoping to benefit from this pent-up travel demand? We'll get insights from 3 Morningstar equity analysts in a bonus episode of Investing Insights. The Market X-Ray podcast looks at investment opportunities and risks that go beyond the market headlines. Let's begin this leg of the trip with equity analyst Burkett Huey, who covers the airline industry. Hi, Burkett. Thanks for coming on. Will you tell our listeners a little bit about yourself and what it's like to be a travel analyst?
Yeah, so my name is Burkett Huey. I am the aerospace, defense, and U.S. airlines analyst over at Morningstar. I've been at the company for about 4.5 years, and I really like covering travel and air travel in particular because it's tangible and it's kind of fun to look up in the sky and see a Southwest plane going into Chicago O'Hare Airport, which Southwest recently expanded to, and kind of understand the strategy behind that.
The second summer of the pandemic is ahead. Can you tell us what kind of financial situations the major airlines are dealing with right now?
Yeah, so the pandemic has really had 3 stages so far. The first was raise as much cash and cut as many costs as possible in the spring and early summer of 2020. The second was conserving cash, very gradual increases in demand during late 2020. In 2021, leisure travel, at least domestic leisure travel in the US, has expanded significantly with increasing vaccinations, and airlines are really hoping to rebuild their network and profitability. Financially, the airlines have really raised debt, mortgaged off valuable assets, and sold equity to survive. Now, the U.S. industry as a whole is left with about $58 billion of additional debt, which is an increase of about 55% relative to 2019. The market capitalization of S&P 500 listed airlines is about $100 billion, so it's quite a bit more debt.
Oh, wow. Well, what challenges could they face going forward to become profitable again?
Yeah, so I'd say the biggest challenge is going to be matching supply with demand. A plane operating a route is going to have very similar costs, whether the aircraft is totally full or totally empty. So any open seat on an aircraft is essentially money left on the table for an airline. So it's really important to fill up planes. In 2020, airlines flew a lot less, and the routes that they ran were nowhere close to full. For domestic routes, load factors, or the percent of an aircraft seats sold, had been hovering at about 50% for late 2020, and that shot up to about 70% of March in 2021. So this is a big step closer to profitability, but the airlines had load factors in kind of the 80% range pre-pandemic. I think the real question for airlines this summer is how much demand is coming back and where is it going? And if they answer that question right, they'll start to rebuild that 2019 network and start getting back closer to profitability.
So we have leisure, there's business and international travel. What kind of activity do you expect to see from this trio in the next year or so?
Yeah, so leisure travel was by far the fastest to recover. Demand picked up with vaccinations in March. Demand looks set to return to a run rate of 2019 levels later this year. Southwest recently announced that it would be running about 95% of 2019 June capacity this year as pent-up demand from lockdowns is released. I'm largely expecting travel to recover sharply over the next few years to recover to 2019 levels and then to normalize to, about GDP growth. The price of oil is probably going to be a swing factor because airlines pass oil prices onto the consumer and leisure travel is a relatively elastic good. If there's an oil-driven commodities boom, maybe after that growth normalizes to below real GDP. But if Brent oil prices stay in roughly that $55 to $75 sweet spot that it did from, say, 2015 to 2019, which is what Morningstar's mid-cycle oil price implies, I think we can expect to see at least GDP growth over the next cycle. In terms of business travel, that's hovering around 20% of 2019 levels for airlines. I'd say the big components for the return to business travel are, returning to the office, the return of large conventions, and what proportion of business travel is substituted by Zoom. And I'm expecting that we'll start seeing business travel pick back up later this year as offices reopen. And, international travel as a whole, it was also kind of around 20% of 2019 levels. As more nations roll out vaccinations, we're hoping that we can see international travel corridors pick up. The big three markets for the US are Latin America, Europe, and Asia. Latin American travel has essentially already recovered, and we're still waiting on a corridor to open up to Europe and Asia.
Tell us the airlines who are doing the best out of the pack.
Yeah, Southwest is probably the one under my coverage. The company's network is positioned almost entirely towards domestic leisure travel, and that looks set to recover before business travel and international travel. And the company doesn't have quite as much exposure to business travel as the other airlines do.
How do our listeners turn this into an investment opportunity? What are the action steps?
I'd say that the sector as a whole is fairly valued. I think the market has given airlines a lot of credit for reopening and a post-recovery, travel recovery. The company where I'd say the market has the biggest disagreement with me is Delta, which is trading in 3-star territory, but it's kind of close to 4-star territory. My target price implies about 15% upside from current levels. But I think there's still a lot of uncertainty left in the sector. So I think investors need to demand a deep discount to a company's intrinsic value before, taking a position in a company like this. And I don't think that current prices offer that opportunity.
Thanks, Burkett, for your insights. You gave us a lot to think about today about the airlines.
Thank you.
We're going from the skies to the seas. And joining us now is senior equity analyst Jamie Katz, who covers the cruise industry. Hi, Jamie. I appreciate you coming on Market X-Ray. Can you tell our listeners about yourself and what it's like covering cruise lines?
Sure. So I've been with Morningstar for about 10 years. I cover a number of different consumer discretionary names. So we look at cruise lines, power sports, boats, toys, things like home improvement. And we get to see a lot of interesting trends across consumer spending spaces. With regards to cruise lines, they've become really fascinating. The liners tend to continue to innovate on both hardware, so thinking about the ships and what they're putting on it, and then the onboard offerings. And that makes ships today really different than those of prior decades. Most interesting is over the last year, we've really got to see how regulatory, legal, health organizations interact with the industry, particularly as the cruise companies have become more eager to restart sailing domestically in recent months. So this full stop across the industry at the beginning of COVID is an event that has never been experienced before by the financial community and by travelers.
So as you said, the cruise industry is ready to get back out there and set sail from the U.S., but they're also calling out the CDC over the restrictions they're facing. What are the issues?
Yeah, I think it's important to go back to see how far we've actually come. So originally, when the no sail order started in March of 2020, all of the fleets were basically removed from the seas. That moved to a conditional sailing order in the fall of 2020. And that CSO initially sought to move forward utilizing 4 key steps: testing of crew, simulating voyages, going through a certification process, and then returning to passenger sailings in order to figure out how to best mitigate the spread. And some of those explicit steps were really viewed as onerous. And I think as time has passed now, vaccinations have become more widespread. Cruise companies have shown willingness to have almost all workers and travelers vaccinated. And there's been access to a lot of data from international sailings over the last 6 months that show that mitigation protocols are working. Since this sample data is out there and exists, it has allowed the CDC to sort of warm up to a full restart in recent months. So as we think about what has happened and how this has progressed, there's been a lot of traction, probably since March, in discussions between the CDC and the cruise industry.
So the cruise industry did receive bad press early in the pandemic due to COVID-19 cases aboard multiple ships. What are they doing now to show their ships are safe for guests?
So I think when we look at the negative press that surrounded those few ships at the beginning, there were meaningful outbreaks. The ships were facing pretty difficult logistic situations. They were unable to determine an appropriate way to disembark, given that there were these positive cases on board. And at the origination of COVID, a lot of this had to do with the fear of uncertainty, the situation that a lot of governments didn't know much about the virus, how it spread, how contagious it was, and so on. And so I think a lot of countries were erring on the side of caution and preventing ships with positive cases to port. Now that we look at the restart in sailing, there have been a number of protocols that have been implemented to allow these cruise companies to really see how well their controlled environment fares in preventing the spread of COVID-19 cases that might make it on board. So we're looking at things like lower initial ship capacity with the ship sailing less than full, servers at buffet areas to prevent multiple individuals from touching food items, limited attendance at shows or programs on board, mandatory vaccines, quarantine capabilities, COVID tests for workers before interactions with customers, HVAC updates, medical updates, and cleaning protocols. So this is really a multifaceted approach in ensuring that consumers can travel safely. And I also want to note that these efforts are really above and beyond any efforts implemented by other travel industries. If you look at air, hotel, casinos, those businesses have really stripped their capacity constraints and require no proof of vaccination for their consumers. So the cruise lines are really trying to create a safe bubble for their passengers.
So the CDC eased some restrictions in April, saying cruise lines can restart if almost all passenger and crew are vaccinated. What's been the cruise lines' response?
The cruise lines have been largely in support of vaccinated guests on cruises. Norwegian was the first one out stating that they would only take guests with vaccinations, making its protocols even more stringent than the CDC's. So looking for 100% crew and guest vaccinations going into initial sailings. So that implies guests age 12 and up, those that have access or the ability to access a vaccine at this point. This was sort of echoed by Carnival, also noting that initial itineraries, those that are included are the Alaska deployments for Princess, Holland America, and Carnival. Those travelers will also have to have their final dose of an approved COVID-19 vaccine at least 14 days prior to the beginning of the cruise, and they do have to have proof of vaccination. I think when we look at Royal, the rules appear to be modestly less stringent. They're requiring all guests 12 and older to be vaccinated, but they are willing to test those under 12 as those passengers do not have access to a vaccine yet, to ensure that there's minimal risk of exposure on the ships, and then ensure that they're able to get families back on ships. So I think when you look at the 3 large ship lines together, Norwegian, Carnival, and Royal, they're really taking steps to ensure the probability of COVID getting onto the ships at embarkation points are low.
So Morningstar raised the company's fair value estimates. However, their valuations are not considered a bargain. Why is that?
So when we raised our fair value estimates on Carnival and Royal, we did it in response to the recent momentum we had seen in deployment planning for the upcoming summer season. And originally, while there were some domestic constraints still existing, Carnival and Royal had pivoted to deploy its fleet abroad. And it started to line up summer sailings from the UK, Italy, Greece, Cyprus, and other ports, right? And with Alaska now set to see some ships this summer, we have a date for ships in the US to start sailing, particularly on the West Coast. That said, the cruise lines are facing startup costs that come ahead of revenue sailings, which could really disrupt the profit profile in the near term. We don't really think that consensus is accounting for the likelihood of these higher costs affiliated with COVID-19 protocols that could really remain intact once the virus subsides. And that could hinder the speed at which profit margins recover. So if you look at how our EBITDA margin improvement grows, it's a little bit better than consensus. So as we look at 2023, which is really the first normal full year of operation with capacity and occupancy levels restored, we should have EBITDA margins in the high 20 to 30% range at Royal, Carnival, and Norwegian. I think as we look at the cruise lines, though, we would wait for a pullback in share price to be buyers in the space. We do see another way to play the outdoor lifestyle. Ownership in names like Malibu Boats and Polaris are much more attractive at their current trading levels. And like cruise lines, both benefit from things like higher employment and savings rate across the consumer population. And both the boating and power sports industries are facing a healthy backlog of orders, and that supports the shipment demand ahead. So if we think about having to resort to a reinstitution of social distancing orders at any point, both names benefit from offering socially distant outdoor activities, with Malibu trading at more than a 20% discount to our $97 fair value estimate, and Polaris at around a 24% discount to our $173 fair value estimate. We think these are better investment opportunities in the consumer discretionary space at this time.
Thanks, Jamie, for sharing your thoughts.
Thank you for having me.
Our discussion has taken us from the air to the sea and now to some place to stay. Dan Wasilek is a senior equity analyst, and he covers online travel agencies. And we're going to delve into one in particular, Airbnb. Hi, Dan. Thanks for being here. Will you introduce yourself to our listeners and tell us what it's like keeping up to date on vacation rental companies?
Yeah, hi. Thanks for having me. So I've been in equity research for nearly 25 years, with the most recent 6 being here at Morningstar, following travel-related companies like Airbnb. In my view, travel is an exciting and interesting area to cover, since many can personally relate to it, and since the industry is one that historically grows above GDP, making a dynamic market to cover, and that certainly has been the case the past year with the pandemic.
Dan, Airbnb recently released earnings. Some good news came from that. What did the company report?
Right, yes. So since the pandemic outbreak, Airbnb's vacation rental listing demand has experienced relative outperformance to traditional hotels and air travel within the industry. The driver of this performance has been the high amount of remote working, which has provided flexibility to travel while working, and the pandemic preference for local road travel to accommodations and destinations where social distancing is easier, which benefits full-size homes and other alternative accommodations that Airbnb offers. That strength continued in Airbnb's first quarter, with its bookings surpassing pre-pandemic levels. This stood well above peers Expedia and Booking Holdings, where their bookings returned to about half of their 2019 levels, as those companies have more hotel exposure, where social distancing is tougher to achieve than staying at a home, condo, or treehouse, etc., that you can find on Airbnb. In addition to strong demand, Airbnb is also making strides to improve upon its cost structure, which was run inefficiently as a private company. And here we continue to think the company can ramp to a mid-20% operating margin in several years from the negative 10% it reported in 2019.
Where does Airbnb's edge lay against rivals like Booking and Expedia?
Well, Airbnb has become a verb and a noun in our society, right? So Airbnb is the leader in the $150 billion vacation rental booking market, where we estimate it has nearly twice the booking share of number 2 player Booking Holdings and around 3 times the share of the number 3 player Vrbo, which is owned by Expedia. Its edge in this market is driven by its nearly 6 million listings, the vast majority being individual owners, which are much harder to aggregate on a platform than larger professionally managed properties that are more often found on a platform like Booking.com. This unique supply in turn helps drive strong global awareness and bookings. So Airbnb is a top 10 travel app in about 90 countries. And a high amount of their visitors come direct to the app, which cuts down on the amount of marketing it needs to do to acquire customers.
The company's booking rates surpass pre-pandemic levels. Can Airbnb sustain this?
That's a good question. I think our view is that the actual night rates sustainability is unlikely to continue for, a period of time. Airbnb's first quarter average nightly rates, I think they were about 130% of 2019 levels, and they were up maybe around 30% from last year to $160 a night. But the vast majority of this increase was due to a higher mix of US and larger size accommodations, which we believe is a temporary phenomenon. As global vaccination rates improve, we expect the travel recovery to continue to broaden to other geographies and types of accommodations, like hotels, something we've already seen in places like Las Vegas, where weekend hotel rooms are already booked out through this summer. So it is important to realize that a driver of Airbnb's recent overall booking strength is this higher rate, which we think is likely to wane somewhat by the next several quarters.
Morningstar rates Airbnb's fair value estimate, but not nearest trading value. Why is that?
Yeah, so we did recently raise our Airbnb fair value estimate to $84 per share from $75. And that was really driven by the stronger demand recovery this year that we just talked about a moment ago. And this fair value estimate remains well below the current share price. And the current share price is down about 35% since mid-March versus, I think, around a mid-single digit increase for the S&P 500 during that time. We forecast a lot of positive growth for Airbnb. So, for example, we expect Airbnb's revenue growth to average 23% annually over the next 10 years, and for their operating margins to expand to 25% by 2028 from a negative 10% in 2019. So our expectation is that Airbnb financially is going to perform extremely well. But in our view, at the current share price, investors are pricing in too much exuberance for long-term revenue growth and operating margin expansion.
So is there an investment opportunity right now?
In Airbnb specifically, it's a great company, but as far as an investment opportunity, we still do think it's overvalued. It's one to keep on your radar if shares were to continue to pull back. Right now, most travel companies are in the overvalued camp as they do appear to be pricing a stronger global recovery. One exception in our view would be Sabre, which is ticker SABR. It does trade at a discount to our $17.10 per share valuation. And Sabre is more exposed to corporate air travel, and that is going to recover later in the demand cycle than alternative accommodations. And so Sabre's share price probably is going to remain pretty volatile and require some patience. But outside of Sabre, again, we keep an eye out for further share price corrections in companies that have strong competitive advantages. And that would include Airbnb, Booking Holdings, Expedia, and then on the hotel side, Hilton and Marriott.
Thanks, Dan, for the deep dive.
No, thanks again for having me.
There you have it. We've flown, sailed, and didn't overstay our welcome at the host home. Thanks for listening to Morningstar's Market X-Ray podcast, where we look at investment opportunities and risks that go beyond the market headlines. I'm Ivana Hampton, a senior engagement editor at Morningstar.
Expand your investing horizons and look to the long term with Morningstar's podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Now, here are Christine Benz from Morningstar Inc. and Jonathan Guyton from Cornerstone Wealth Advisors.
Hi, I'm Christine Benz from Morningstar. The topic of sustainable withdrawal rates has been getting a lot of attention lately, with some researchers arguing that starting withdrawal rates ought to be lower. Joining me to discuss that topic is Jonathan Guyton. He's principal at Cornerstone Wealth Advisors, and he's also done significant research on the topic of in-retirement withdrawal rates. John, thank you so much for being here.
Glad to do it.
Let's talk about the starting withdrawal rate and the sustainability of starting withdrawal rates. There's recently been some discussion, well, actually, it's been going on for a while, about whether the 4% guideline, whether a 4% starting withdrawal is sustainable. Do you think that taking fixed real withdrawals, which is the strategy that underpins a 4% style system, is really not the right way to go about it? Can you talk about that?
Sure. Well, it's an interesting time to be talking about withdrawal rates overall, in part because of what's happened over the last couple of years, which is that because equity markets have done so well, portfolio values are larger, quite a bit larger than they were, let's say, at the end of 2018. And so it wouldn't be surprising for a retiree to look at their portfolio and the amount they take out and calculate their withdrawal rate and find that it's 15 or 20% lower than it was 2 years ago. So in a sense, the talk about you need to start at a lower place is much ado about nothing, because that's where you already are. It's certainly where existing retirees already are. To your point about fixed real withdrawals, of course, that goes back to the groundbreaking work that Bill Bengen did about a little over 25 years ago. And it's not so much that I think that that's the wrong approach, but I think that it's an approach that doesn't really match human behavior. And so for people who pin their retirement withdrawal strategy on something that says you get a raise for inflation every year, whether you need it or not, there's a little bit of a disconnect there. For one thing, most people who spent their entire working careers saving for retirement and put themselves in a good position had to do so through years where spending needed to fluctuate. Maybe 1 year, somebody was out of the workforce for a period of time, or another year, somebody got a bonus, and the next year you didn't get a bonus. And so we get used to making adjustments in the spending decisions that we make, particularly around things where there can be flexibility. And so I've just felt that to incorporate that behavioral element into how we think about withdrawal rates is something that could be helpful, especially if that kind of flexibility could mean that the amount you would take out could be higher than if you didn't have that flexibility. And of course, that has turned out to be the case that the research has shown.
Well, let's talk about that, how that flexibility can actually help improve sustainability. Can you talk about the interplay between being willing to be flexible about withdrawals and potentially also increasing the likelihood that your portfolio will last over all of your retirement years?
Absolutely. So, when you think about the withdrawals that you take out of a portfolio from 1 year to the next, let's say from last year to this year, there really are 4 different things that could happen. One is you could increase what you're taking out by inflation. That's the static method that you referred to earlier. The second is you could just take the same amount as you did last year with no increase. The third possibility is you could reduce what you're taking out. And the fourth possibility is that you have an increase that is actually more than inflation. So when we're talking about flexibility, what we're saying is we're putting all of those on the table based on the conditions that are going on at present right now. The analogy I like to use is like you're driving a car. So you're on the road, you're driving the car, without even thinking about it, you're looking in your mirrors, you're paying attention to what's going on. The road conditions and the weather conditions all matter. And sometimes you need to take your foot off the accelerator. And sometimes you need to tap the brake. Hopefully you never need to slam on the brake. But just those little things, adjusting your speed slightly. If I were to say to you, start your trip, and you always have to keep the exact same pressure on the accelerator all the time, Well, first of all, you'd think I was crazy. But the second thing you'd say is, well, if I had to do that, I would have to go much more slowly. And the speed is the withdrawal rate. So if you have the option to take your foot off the gas or tap the brake, you can go faster because you have the ability to adjust. And the same is true with the money you take out of your portfolio. If you have the ability to make small adjustments, then you can start out by going faster, which is a higher initial withdrawal amount or withdrawal percentage.
So people might hear about this idea of taking flexible withdrawals, and they might immediately latch on to the idea of just taking out a same percentage year after year. So just taking 4% year in and year out. Does that kind of system work for people in practice? It seems like it would lead to potentially too much variability if you're just tethering your withdrawals to whatever's going on in your portfolio.
Well, it certainly wouldn't work for me because if your portfolio happened to drop by 20%, that means that next year's withdrawal is 20% lower. So not only are you dealing with a big decline, but you also didn't have time to prepare. And so fortunately, there are other approaches that can allow you to be flexible without that tether, but also that do take into account that, hey, if my balanced portfolio drops 20%, well, first of all, that probably meant that the stock market went down over 30 for my portfolio to go down 20. But there are ways to make smaller adjustments, and if things get better, that you only have to make one small adjustment. If things stay bad, you may have to make several adjustments over a couple of years just to be sure. It's the kind of the stitch in time saves 9 approach.
The system that you pioneered, you worked on with William Klinger, it's sometimes called the guardrails approach to setting your withdrawal rate and then adjusting it as time goes by. Can you kind of shorthand that for people who are interested in being more flexible but want to ensure that they don't have these radical swings in their standard of living based on what's going on with their portfolios?
Be happy to. It goes back to that car analogy and the different changes that you can make potentially to what you take out each year. So like I said, you're putting all those on the table, and it's just a matter of knowing when you need to use each one of them. So there are a couple of things you need to know, just like things you need to be aware of when you're driving the car. You need to know what your withdrawal rate or your withdrawal percentage is right now. And that's easily calculated. It's just what are you withdrawing over the course of a year, including what you pay in for taxes if there's any tax money withheld from, say, an IRA distribution. And you divide that by what your portfolio is worth at the beginning of the period. And you could calculate your withdrawal rate every day if you wanted to, but doing so once every 3 to 6 months is certainly appropriate enough. The second thing you need to know is at what point would that withdrawal rate change to a degree that you might need to make some kind of adjustment. And so that's the guardrails that you spoke about. Back to the car analogy, if there's icy roads or there's fog and you just can't control where the car is, you sure hope that by the edge of the road there are guardrails there that you can kind of bump into and keep you from going over the edge if things really do get dangerous. And then that's the analogy here. So let's suppose that right now, given where I mentioned earlier that withdrawal rates are a little lower for most people because equities have done well. So let's say that your withdrawal rate is down right now at 4.6%. And normally it might have been closer to 5. And you've said that I'm going to set my guardrails at 20% above 5 and 20% below 5. So that would be 6 and 4. And right now you're at 4.6. So what happens is that in a normal year where you're between those two ranges, you give yourself a raise for inflation, just like you would normally do under any other approach, except if last year's investment return was negative. And if last year's investment return was negative, then you just freeze. You don't give yourself that inflationary raise. And that's all you need to do. And you go on to the next year. And the next year that occurs, you measure what your withdrawal would be, and you calculate that percentage. And as long as it's between 4 and 6, that's all you really need to do, like I said earlier. But let's suppose that the stock market drops, and over time, it takes a while to recover, and your withdrawal rate is inching up, and you find that, okay, the amount I would take out this year, if I adjusted for inflation, would actually be 6.3%. And that's about, you've hit the guardrail. That's above the 6% number. So what you do is whatever dollar amount that is, okay, you just reduce that by 10%. That's the largest adjustment that you would make at any point in time. So if you think about it, if your withdrawal rate was going to be 6.3 and you knock 10% off that, that takes it down to about 5.7. You're back in within that range. Now you're pretty close to the top, but you're still okay. Maybe the market starts its recovery. Maybe it starts to bring your withdrawal rate back down. Maybe it doesn't. Maybe next year or a couple years later, you need to do that again just to keep things safe. That's what we found in the research, was that when you start to get above that, you need to do something to kind of take a little bit of the pressure off your portfolio. The other thing, and this is actually what's a little more relevant today, as withdrawal rates are falling. Notice I said, imagine you're at 4.6 right now, and that lower guardrail is 4. Well, what happens if you go below that? You know, the markets continue to do well, your withdrawal rate drops to, say, 3.8%. Then, if you want, you get a bonus. You can just take whatever your withdrawal would have been and move it up 10%. And that just becomes your base going forward. That's because you've created so much extra room, so much safety, if you will. Things were so much better than you might have than you would have predicted, that it turns out you can do even more. And what this research shows is you can take that money once you've hit that other threshold. It takes that 3.8 number and moves it up by 10%. It's now 4.2. You get to enjoy that money and you go on from there. So it really just comes back to knowing your withdrawal rate at any point in time, knowing where your guardrails are, and then making the adjustments for the 10% of things, shifts only when you need to. I'll make one other comment. Sometimes people hear that and they say, wow, I might have to reduce my income by 10%. That's actually not true. First of all, your Social Security benefits didn't change. It's only the income coming from your portfolio. Secondly, if your withdrawal rate has been rising, it's because your portfolio value has been falling. That means, for instance, your IRA isn't worth as much. It means your required minimum distribution isn't as high. So when you reduce the amount of money you take out, part of that money is money that would have gone to income taxes. So, if your withdrawal happens to be, if it would have been 50,000 and you knock it down to 45, you don't really lose 5,000. You might only lose, say, 3,500, because the rest would have been taxes you would have had to pay.
That's a helpful encapsulation. I have a related question, which is about the where of withdrawals. And I'm curious how you approach this with your clients, in terms of whether you suggest that they spend any sort of organically generated income that's coming from stocks and bonds in the portfolio. Or would you suggest that they reinvest those dividend distributions back into the portfolio and then just do rebalancing? How do you approach that issue?
Well, you pretty much just answered your own question, because whether you use mutual funds or individual securities or exchange traded funds, you know that many of these pay their interest or dividends regularly, whether it's monthly or quarterly. So they're always making money available that you're going to need to take out, or you're going to want to take out, because most retirees like their regular portfolio income to come monthly. So this is actually a monthly question, or it's a period where you need some money available every month in order to do so. So we find that taking interest for any account where you're withdrawing money regularly, now you might have a Roth IRA, for instance, that you're not drawing from regularly. So there, of course, it would make sense to reinvest. But when you're drawing money out regularly, go ahead and have that interest and dividends in cash. It just means that's there to help fund what's coming up. Then, like you said, you will rebalance periodically and certain equity asset classes hopefully are overvalued. That means equities have been doing well. You'll sell some of those off, and that can be used as another source. Rebalancing, of course, works the other way too, which is when markets fall and your equities are undervalued, you have an opportunity to repurchase those. The best opportunity we've had in the last 10 years to do that occurred March a year ago in the teeth of the pandemic. And then finally, if all the equities are in the tank and the interest and the dividends or the cash that you're holding is not enough, then you're looking at selling some of the fixed income that you're holding, which is exactly what it's there for. It's a common misconception. We find that people think that the primary role of fixed, or the only role of fixed income bonds in retirement for distributions, is the interest that they pay. Yes, the interest that they pay is useful, but the most important reason why you have bonds is to have something that doesn't go down when equities are down, and you don't want to touch them until they recover. And so when you're looking at doing that, that's really when you would be selling some fixed income in order to do that. But that's the basic order. Cash you might be holding, interest, dividends, rebalancing from the equities. And if that isn't enough because conditions are just not good right now, you're going to be selling some of the fixed income along the way until you're pleased that equities have recovered enough to start using them again.
Okay, John, this has been such a helpful discussion. Thank you so much for being here today.
Glad to do it. Thank you for having me.
Thanks for watching. I'm Christine Benz for Morningstar.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. And lastly, Ben Johnson from Morningstar Research Services talks about crypto ETFs with Susan Jabinski from Morningstar, Inc.
I'm Susan Jabinski with Morningstar. Several ETF sponsors have asked the Securities and Exchange Commission for approval to launch cryptocurrency ETFs. Here to talk about whether the SEC will approve and how investors might use crypto ETFs is Ben Johnson. Ben is Morningstar's Director of Global ETF Research. Hi, Ben. Thank you for being here today.
Thanks for having me, Susan.
So, why would investors want a cryptocurrency ETF? And what role could this type of fund play in a portfolio?
I think there are a variety of reasons that investors want a cryptocurrency ETF. I personally would argue that many of them are probably the wrong reasons, and the chief among them being that it's an asset whose price has gone up a lot over a short period of time. So, as investors, when faced with the choice between one marshmallow today or two marshmallows tomorrow, we always want two marshmallows today. And crypto, I think, in the minds of many, is the way to get your hands on those two marshmallows as quickly as possible. So I think the want is really, frankly, just driven by the price appreciation that we've seen for this asset. Now, let's separate wants from needs. Why might an investor need a cryptocurrency ETF? Well, cryptocurrency ETFs would, in many cases, present an incremental improvement over different ways that they might otherwise access these different assets today, chiefly with respect to integration into their existing investment portfolios. These are assets that are typically held outside traditional investment accounts, outside investors' traditional investment portfolios. So there's a convenience factor, certainly, which is, I guess, sort of a hybrid want in need. That degree of integration could be helpful. They might also simply need help accessing this asset. They might not be able to navigate all of the myriad ways that you can access it today, many of which, quite frankly, are incredibly easy, but nonetheless, they might have a greater level of familiarity, a greater level of comfort, knowing that this asset is overseen in a regulated investment product. It's a product that they can trade on a traditional stock exchange. It's a product that they can hold in their traditional brokerage account, and it integrates directly with their portfolio. It's custodied. In many cases, the proposals that are out there include an insurance feature that might just simply be easier for many investors. It might help them sleep better at night. It might help them keep closer tabs on whatever positions they're taking in crypto assets. Now, whether or not wants and needs net out for one or another is anybody's guess and is really going to be case specific. But I think it's important to understand why investors might want a crypto ETF and really the practical realities, the practical benefits of putting crypto assets in a regulated investment product that trades on exchange.
Now, the SEC hasn't yet approved any cryptocurrency ETFs here in the United States. And why do you think that is? And do you think that the SEC will eventually approve these products?
Yeah, so it's been a long dance with the SEC for a lot of these aspiring crypto ETF providers. They were effectively told to go and put things on ice if you go back a number of years. And at that point in time, the SEC spelled out in exhaustive detail what its concerns were with the proposals that were on the docket at that point in time. Now, some of them just had to do with the plumbing of the crypto ecosystem, things having to do with custody, for example, who's going to hold these assets, how are they going to hold them, how are they going to account for them to move them around, what have you. The other concerns that the SEC cited at the time that linger to this day, and it's difficult to discern whether or not they will ultimately resolve, had to do with the potential for manipulation and fraud in the underlying crypto markets. Now, if you look back at some of these letters, those two words were mentioned in some cases combined a few hundred times in the SEC's comments on these filings. You fast forward to today, it's difficult to say whether those have really fundamentally been addressed. Now, what we've seen in the intervening period is that there have been different product types that have come into the market in the US, specifically certain crypto trusts that aren't necessarily a good vehicle for many investors. And you've seen other regulators outside the US approve crypto exchange traded products in their local markets. So there have long been crypto products available to investors in Europe. Most recently and most notably, what we saw was that the Canadian securities regulator approved a number of different crypto products. At first, a trio of Bitcoin ETFs for trading in Canada. So whether or not the SEC remains a holdout, remains sort of the uncool regulator on the global scene, frankly, is anybody's guess. What we are seeing from them in recent weeks is more communication, greater transparency around what they're looking at, what their concerns are. And this has led some to believe that a launch is imminent, others to think that it's probably further out than previously anticipated. At the end of the day, really, it's anybody's guess. And many investors, certainly those who absolutely want crypto, still have any number of different ways that they can access this asset outside of registered investment products.
So let's say that the SEC does eventually greenlight these products. What are the risks that investors need to be aware of specifically with a crypto ETF?
I think the biggest risks that investors face with crypto is no different than the risks they face in their existing investment portfolios. And it's the one that stares them in the face when they look in the mirror each and every day. I think the biggest risks are really behavioral. This is an incredibly volatile asset. It's an asset that really is just driven by narrative. It's really no different than Fiat currency, it's no different than why we assign value to gold. There are no cash flows here. There are no fundamentals to analyze. It's an asset that is going to be worth whatever someone is going to be willing to pay you for it, either today, tomorrow, or 10 years down the road. It's purely speculative. And as such, the animal spirits are really going to rule the day here. And your own animal spirits are going to be the biggest risk that you face, that you either decide to participate surely because your neighbor's participating and the next person down the block is participating and they got to buy a nice new set of golf clubs or a shiny new car because they made a lot of money with these assets, or the risk, I think more fundamentally, that you start to allocate money that was meant for other uses to an asset that is speculative. So what putting crypto in a registered investment product does is it allows investors to potentially allocate to crypto in an IRA, for example. Now, if those are retirement assets, in theory, depending on who you are and how old you are, you might have a lot of time and you might have a willingness to take that level of risk. But again, I think the biggest risk is that you don't know the risk you're signing up for. You sign up for it for the wrong reasons, because we've seen this asset class appreciate tremendously over a short period of time. And then when you see market environments like we saw on May 19th of this year, where the asset suddenly sells off in very sharp fashion, you don't know what to do. And you run for the exits at the wrong time. You allocate more money than you were originally willing to commit because you're trying to buy the dip. Your behavior ultimately is what's kind of winning the day, and not kind of coolly rational sort of investment rationale when it came to what informed your decision to make this allocation to begin with.
Well, Ben, thank you so much for your time today and your perspective on this very high interest potential new product. We appreciate it.
Thanks for having me.
I'm Susan Jabinsky with Morningstar. Thanks for tuning in.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.